Soumyakanti Ghosh, Chief Economic Advisor at State Bank of India, now joins us. Mr. Ghosh, thank you so much for joining us. The market's pricing in nearly a 25 basis point cut this time. What are you working with, and is there more to come on the anvil?
Yes, we are actually penciled in a 25 basis point rate cut tomorrow, and we expect that there could be as much as 50 to 75 basis point cut in the current cycle, including the cut tomorrow. So there is every possibility that the repo rate, the terminal repo rate at the end of this rate cut cycle could actually be closer to 5%, given the current growth and inflation conundrums.
Sir, good afternoon. Ira joining in as well. Is there any argument to be made for a 50 basis point cut right now?
See, I think the arguments against a 50 basis point rate cut could be a little more than for a 50 basis point rate cut, simply because of the fact that given the global developments, and I think currently the 2019 slowdown which we are looking into, I think that is a little more risky than the 2008 crisis, because if you look into the 2008 crisis, most of the central banks, all the central banks were not cutting rates. Even in fact some of the central banks were raising rates, including of the emerging economies. But in 2019, I think almost all central banks are cutting rates, and Thailand and possibly Mexico will cut rates in the forthcoming policy. I think Thailand policy is again on tomorrow. So after that only I think two central banks, that of UK and Canada, will hold on for any rate cut. So my sense is that currently the situation is more volatile than what it was in 2008, because the global trade conundrums, the external strife has actually got into the internal strife and the domestic quick growth impulses of the emerging economy. So that these two mixture makes a heavy cocktail. So a higher rate cut could actually precipitate a larger amount of capital outflows, and that could put pressure on the rupee. You can already see that the rupee is under a little bit of pressure because of the yuan developments, and if that continues, because independent estimates suggest that the yuan, currently the yuan is actually closer to 7, but independent estimates suggest that a depreciation in the yuan rate of close to 7%, which makes the yuan number closer to 7.4 or 7.5, could make all these measures which the US has taken completely neutral. So from that point of view, we don't rule out further weakening of the Chinese currency, even though the US Treasury had put out a note. And if that is the case, the central bank could be a little more careful in cutting rates more than 25, because at this point nobody will want that should precipitate a currency crisis, because already the growth numbers doesn't look inspiring as of now.
Mr. Ghosh, on the growth numbers per se, so I think your note had pointed out that Q1 could be weaker than Q4. So you would expect that the RBI, well, if not this time, but next time, would peg down its full year growth forecast as well?
Of course, I think the Q1 growth numbers, we are penciling it at 5.6%, and if 5.6%, if any number closer to 5.6 or even 5.7 is a reality, I think the full year growth number could be closer to 6.5% or even less. The moot point is that we'll have a growth numbers in FY20 that will be lower than that in FY19. So that means that the numbers, and even though we expect that some sort of a recovery could happen in the second half, but also the fact that this time the festival season is a little delayed, because I think the Diwali falls in the last week of October. So given this fact, I think even though there could be some festive season cheer, but that will not materially impact into maybe a better numbers, and second half numbers will obviously be better, but it remains to be seen how far it is going to offset the first quarter weak growth impulses, because there is nothing on the ground to suggest that the July to September growth numbers could be significantly different from the Q1, even though it could be higher. So net we could get a growth numbers which could be closer to 6.5 or even lower than that in the current fiscal.
Okay, Mr. Ghosh, just last two questions. How much focus do you think you'll see from the RBI on liquidity? There are two aspects to it. One is that we are waiting for that review report that the RBI had undertaken of the liquidity benchmarks. Will we get, you think, anything on that? And two, would you not like to hear from them how they are ensuring that all of these rate cuts are going to transmit to the system? And I know the banking system is a problem, but now even the bond market is a problem. So, in many ways, what's the point of cutting rates unless you fix the pipes?
No, that's a valid point, Ira. Always transmission is always a challenge in the Indian context given the operational constraints which the banks face. But our sense is that if you actually look into the data, the liquidity data and all the rates of most of the banks, you will see that most of the banks have cut their MCLR around 15 basis points to 20 basis points in the rate cut cycle started. And a large part of the rate cut is actually happening after the liquidity went into a surplus mode. So my sense is that, and given the fact that banks have now started to cut deposit rates aggressively, I can see more aggressive rate cuts on the part of the banks, and I think that could be in double digits, maybe 10 or 15 basis points. And my sense is that will help that will facilitate the RBI, or the RBI actually could keep the liquidity in surplus mode for an extended period, because what happens is that when the liquidity is in a surplus mode, the transmission tends to become faster the longer it stays in that mode. Regarding to your specific question on the GSEC yields, I think the GSEC yields are a reflection of the economic realities at some point of time. So that's why you saw that yesterday, even after the Chinese news came in, the yields initially jumped. Today the yields are actually holding steady at 6.35% levels. And the numbers, the growth numbers, the IIP numbers, the inflation numbers, which are all due in the next fortnight or so, are all going to be steady or relatively weak. So that will ensure that the GSEC numbers will also stay on the lower side. Although, and you can, in fact, today also there was a news that the sovereign bonds may not be forthcoming this year. Even after that, we have not seen much traction in the GSEC. So I think it's now more of a function of the economic realities rather than the demand supply fundamentals of the government bonds.